BIM. What's up, guys? Nick Musunda here, video number 25. Going to be talking about answering the question of should you pay off your mortgage or should you buy more investments in this video. Why should you listen to me? I've been working in personal finance for about 7 years, so just wanting to impart some of that knowledge on the viewer. Okay. So, just to give a bit of context, I was chatting with a couple of mates recently, pretty switched on guys, about price to earnings ratios currently, and whether that represented value in investing in stocks, and whether or not you should just pay off your mortgage, right? So that was what we were discussing. And one of my mates, his position was that PE ratios are historically high, so that suggests you're not going to get great performance out of the stock market moving forward, or as good historical performance if you invest in stocks. And he suggested it would just be better to pay off your mortgage, because paying off your mortgage, most of us are paying about 6% on their mortgages. This represents a 6% risk-free rate of return, right? And this sort of raises a bunch of concepts that are kind of fundamental to investing that I want to explore in this video. Then one of the other questions my other mate asked was, well, you know, what's your position on paying off debt generally? Is debt good or is it bad in this current climate and just more generally, right? So we'll explore that a little bit as well. So a couple of basic concepts I just want to cover off before moving forward. The first one being return. Okay, most people understand what return is in the context of investing, right? If you buy an investment, let's say you pay $100 for a stock, that stock goes up in price 10% and you sell it, that's a 10% return. If that stock paid a $3 dividend, right, this $100 stock, well, that would be an additional 3% return. So your total return on that investment over the course of that year would have been 13%. Okay, so that's return. Everyone understands return. I guess the analogous thing in property, or the analogy for return in property is going to be if you have $1 million house and it goes up $100,000, that's a 10% return. And if it pays $30,000 in rental yields, right? Well, $30,000 in rental income, which would be a additional 3% rental yield. So again, 13% total return. So that's return. Most people understand that. Risk is a little less tangible concept. So I wanted to break down what risk is and look at a couple of quick examples. So risk is equal to the probability of an event occurring times the consequence, or the cost in the case of investments. So if you look at, I'll look at a couple of examples here. So if you look at the risk of me dying tomorrow, passing away tomorrow, right? The risk of me dying tomorrow is going to be the probability, which is assumedly very low, I'd like to think, times the consequence. And the consequence would be considered very high, right? Because if you die, all the contributions you make to your family, your friends, work, your community, that all stops immediately. So it's relatively consequential, right? So you've got small probability, large consequence. Okay, so you multiply the two together. Let's say you get a medium low risk. So risk of me dying tomorrow is medium low. And then you contrast that with, say, the risk of me having my toe stepped on by somebody tomorrow, right? The risk of that happening is much, much higher. Anyone could accidentally step on my toe, but the consequences of someone stepping on my toe are going to be significantly lower, right? Hopefully someone steps on my toe, it hurts a little bit and I get over it, right? So the risk of someone stepping on my toe tomorrow, probability high, consequence very, very low. right? So you multiply those together, and let's say risk is low, right? So risk of getting your toe stepped on, low. Risk of dying, medium low, right? And hopefully that sort of helps you conceptualize risk a little bit better. Now, when we are investing in certain assets, we have to understand that we're taking on risks. There's a risk that we don't realize the return that we hope for or that we expect. So when you compare two different investment options, it's not simply about which one has the most return. You have to have a risk-adjusted return. Let's say you have to make sure that if you are looking for an expected return that's higher, that you're not taking on too much risk, or that expected return warrants the additional risk that you're taking on. Okay, so taking a step back to the conversation we were having and the claims my mate was making about PE ratios and paying off the mortgage. So I want to have a quick look at whether or not this is even valid, right? So let's start by having a look here. So we've got PE ratios. This is from worldperatio.com. PE ratios in the United States over the last 30 years. Okay, so a PE ratio of 20 is this line here, and you can see that the majority of the time it's pretty clear it's not over that. And you can also see that PE ratios in the US are as high as they have ever been in the last 30 years. So that's in the US. This chart has in light blue Australian PE ratios. This is price to earning ratios. Purple's all world, and green is the developed world excluding the US. Again, you've got the 20 here, and majority of the times it's not over 20. So I think the claim that PE ratios are historically high, that's a fair claim. Okay. Now, what does that mean for expected returns? Okay. So expected returns here, we've got a chart. This is in the US. So you've basically, every single one of these dots represents the PE ratio at a given year. Okay, so what's the date range here? 1881 to 2016. So every year from 1881 to 2016, the end, you've got percentage return over the last 10 years in the y-axis. So again, we've got a PE ratio of 20 here. So you can see, okay, well, what's US PE ratio at the moment? It's about 26, 27. So we're over here. So this is sort of the range of returns over the next 10 years when the PE ratio has been around that mark. So it's been positive, but it's around, it's maxing out at around 5%. Okay, you're definitely not getting these 20% returns, annualized returns that you might have got if your PE ratio was below 10. Okay, and there's a clear trend here. So to suggest that the likelihood of getting a positive return is less favorable when PE ratios are high, I think, based on this chart, is a valid claim. Okay, so his position seems reasonable. That's basically what we've ascertained by looking at some of those charts. Now, okay, let's break down the example a little bit more here. So we've got getting back to this concept of risk-free investment. If you pay off debt, because you're not buying any asset or any investment that has risks associated with it, it is basically a risk-free, effectively a risk-free rate of return. Okay. Now, if we compare this with, let's say we've got some investment and we expect to get a return of 10% from that investment. Okay. With that investment, there's going to be a variety of risks, right? There's the time horizon risk, there's market risks for whatever market that investment's in. If it's a business, there's business specific risks associated with that investment. Property has, the risk of tenants not paying, unforeseen maintenance costs, etc. There's a variety of risks you're taking on when you invest in any investment. Now, what we need to ascertain when we decide whether we pay off the mortgage or go and purchase this investment, this hypothetical investment with a 10% return, is whether or not that additional 4% expected return is warranted by the extra risk we're taking on. Okay, so like I was saying earlier, simply just going 10% more than 6%, that it doesn't make sense. You have to understand that you're taking on a certain amount of risk for that extra expected return, and it has to be warranted. Okay, so that's pretty clear. And that's just the risk aspect of it. If we're comparing with paying off the debt on our principal place of residence, the mortgage on the home, there's also the tax aspect of this, which is significant, right? Because that 10% return that I'm getting from my investment, I have to pay tax on that. The 6% cost saving that I'm getting from paying off the mortgage, I don't have to pay any tax on. So after tax, let's say my marginal tax bracket is 30%, right? That means that after tax return is really not 10%, but 7%. Okay? It's 10% less my 30% marginal tax rate. So now, in reality, what I am doing is looking at that additional 1% in expected return against the risks of investing in that asset. Okay? Is it worth taking on these additional risks to get an additional 1%, right? So this is the way where we want to think about answering this question of whether we pay off the mortgage or go and buy some more investments. So that's basically a summary of that question, that problem, that challenge. Now, what else did I want to talk about here? Right. Okay. So, like I was saying, in this chat we were having, my other mate wanted to know, is it a good idea to pay off debt in general? So I want to talk to that briefly as well. So this comes down to your risk tolerance, okay, and it comes down to your time horizon, meaning when do you want to liquidate your investments, okay? So whenever someone invests in any asset or investment, the price of that investment is going to go up and down. There's going to be a level of volatility associated with that. When the price goes down, it's going to be disconcerting for the investor, okay, if they don't have a high risk tolerance. The other thing about risk tolerance that I want to mention quickly is that your financial literacy feeds into your risk tolerance. So if you understand your investment and understand that it has the potential of going down, but the likelihood of it going back up and returning to positive in the future will allow you to withstand those drawdowns in the price of the investment a lot easier. So risk tolerance is critical, and you have to understand, am I the person that can withstand those fluctuations in the price of my investment, or am I more suited to a less volatile investment? Less volatile, I mean, volatility is a proxy for risk in portfolio theory, but that's essentially where the rubber meets the road in terms of risk tolerance. So you need to have investments that are suitable for your risk tolerance and your level of financial literacy. And like I said, time horizon. So if your time horizon is short and your investment is volatile, it may go down in price at a time when you need to liquidate and get the funds, which would mean you would be forced to crystallize a loss at an unfavorable time. Okay, so investing in volatile investments that have big up and down swings in price change when you don't have a long-term time horizon is illogical. So long-term time horizons are suitable for more risky investments that have a higher expected return as well. All right. Now, where does debt come into this? Well, if you use debt to buy more investments, debt multiplies the amount of investments that you can make and therefore multiplies the performance. So if you have positive performance, that's a good thing. It will multiply that. If you have negative performance, it will multiply that. So the fluctuations in your investment are going to get exacerbated if you are leveraged, right? Leverage being another term for taking out debt to buy investments. So it can be good and it can be bad. For 9 people out of 10, using debt to go and purchase investments is not really going to be suitable, right? It's something that probably more sophisticated investors should use, and a lot of really financially literate and sophisticated investors are against using debt to purchase investments. Dave Ramsey's a relatively high-profile money commentator that is not a fan of debt, which I think is reasonable. Is it right or wrong? It's harder to say. It's for some people, they definitely have used debt to, like I say, multiply the performance of their investments in a positive way. And some people have blown up their accounts because they're too highly leveraged as well. So it's good and bad, not to say one way or the other, but it's critical to understand your risk tolerance, critical to understand your timeline when you're looking at whether or not you should be in debt more or less at any given time. Okay, that was a relatively long-winded answer. Okay, lastly, just want to quickly look at this paper from the Federal Reserve Bank of San Francisco, because this is really interesting. It's called the Rate of Return on Everything paper, and it's basically looking at average return of different asset classes over the past century and a half from various different countries. So you can see here, these are real rates of return. Now, the reason I'm looking at this is a lot of people, I think, would probably find it kind of surprising, these rates. And it sort of gives us a reference point as to what kind of expected returns we should expect from our investments. So you can see Australia here. So this is equity, this is stock markets, this is housing, and this is for the full time frame, right? This is just post 1950 and 1980. But over the full time frame of the data sample, equity 7.81, housing 6.37. They've attempted to account for maintenance costs in these numbers as well, which is good, and allows us to sort of compare apples with apples more so. So that's Australia, the US, 8.39, 6.03. So yeah, that's probably, I think, for a lot of people, lower than what they would expect. And keeping in mind, obviously, housing, it's an asset class. When people invest in property, they usually, or often, I should say, buy a house, right? So, some people are going to have the knowledge and skill to buy houses that provide them with a better return than that. So, more power to them. With equities, it's definitely more likely for people to invest in index funds which don't try and beat the market. They basically match the performance of the market. So those numbers there are probably more relevant. But again, there will be people who back themselves in picking stocks. There's a minority of people that can do that profitably. So, but yeah, it's a good reference point for expected rates of returns. So yeah, I just want to close with showing a bit of that data. It's an interesting paper. Yeah, definitely check it out, guys. But that's pretty much it for this one. Thanks for watching.